All right, ladies and gentlemen, I'm Aram Melkoumov. This is the Off the Record Show. Welcome. Today I have alongside me Jonathan Graff. He's a venture partner at Celtic House Ventures. He started multiple companies before switching to the other side of the table, being in venture capital. Jonathan, welcome to our show. Great to have you here.
Good morning. Great to be here. Nice to see you.
Good to see you too. First question I want to ask is to kind of, kick it off is what are you most excited about in your life right now?
Wow, that's a very broad question. There's a lot going on. Perhaps we'll try to keep it to the work environment. I've been venture investing or sort of formally with a VC for a few years, and I must say, the pace of innovation, the number of investment opportunities, the quality of entrepreneurs, especially here in Canada and in Toronto, is remarkable. So the excitement is just the incredible amount of great investment opportunities I'm seeing. So I'm excited about that for myself and for my LPs. But I'm also really excited for all these entrepreneurs and the next generation of entrepreneurs and what they can potentially do, how fast they can grow, how easy it is to start companies. We're seeing entrepreneurs who can raise money so many different ways. So it's not necessarily a plug for the VC industry per se, or exactly how we invest. But there's an incredible amount of ways to raise capital today that didn't exist a number of years ago, and I think they complement and coexist with the VC world. I don't think it's about replacement or dramatic shifts yet, but it's nice to see that there's lots of options for these entrepreneurs. So in my VC work, just the amount of deals and the amount of impressive entrepreneurs is exciting. And then, I work with other entrepreneurs in different ways as well. It's not always about Celtic House putting capital into their business that sort of begins or ends my conversations or work with them. I do a lot of mentorship work. I do advisory work. I do some different kinds of financing work through other vehicles like capital pool companies on the venture exchange. So there's a lot to be excited about.
Nice. And, I've been speaking to a few other investors and entrepreneurs over the last couple of months, and I feel like the abundance of capital is quite high. Like there's a lot of different sources. It's easy to get money these days. Would you say that's true?
I think everybody's probably got a different story there. There's no doubt that the amount of capital available to companies and the options to raise capital are greater than ever. Like the venture cap community, the private equity community are flush with capital. There's tremendous interest in investing in growth due to the environment that we're in by LPs who traditionally weren't pouring such large allocations into this space. So there's lots of money through the traditional sources. So that holds true. That makes it easier. More dollars competing for your company is a great thing. Then there's new regulations in both Canada and the U.S. The U.S. are probably more impactful due to the size and nature. But Regulation CF, Regulation A in the United States has created opportunities for new crowdfunding platforms. One of which I do some work with here in Canada. It's just incredible what they're able to do and the options that they give these entrepreneurs and growth companies, the ability they give them to raise significant amounts of money. So I think I think on some levels, it has become easier because there's more competition and there's more options. The flip side is, I'll talk to tons and tons of early stage entrepreneurs through various accelerators or advisory and mentor roles and things that I do here in Toronto, and the ability to raise early stage, pre-seed, and seed capital is really hard. It's really hard, So part of that hasn't really changed dramatically in comparison to some of the capital available for later rounds. So it's on some level it's easier. We're going to have a long lineup of entrepreneurs trying to get their businesses off the ground in many different areas who are going to say, "Man, this is really hard."
Yeah, it's never easy for an entrepreneur, I think, in the early stages, regardless. So I wanted to ask you about going back in your past, because you actually have an entrepreneur history. You've built some companies before becoming a VC. So let's go to that. Let's go to that past history for a few minutes. I wanted to ask about. I think one of your companies that you worked on, it wasn't that successful, if I recall. You mentioned before it was it was a company that didn't end up making it, and I think you had to shut it down, or it went to the ground. Can you tell us about that business? What was it? What was the model? Where did it go wrong?
First of all, thanks for the morning pep talk. That's great. First hair and makeup doesn't show up, and now this is tough around. I generally present it as we didn't exit that company in the manner that we thought was possible. And I think in there was a question of what went wrong. It's I think like many early stage companies that don't make it, it's really hard to put your finger on that kind of one thing that went wrong. It was a company that was around for in the instance that we're talking about here, it's a company that was around for 5 years. It actually had a successful product in marketplace, depending what you call successful. It was an early stage product that found product market fit. It got up to 50,000-60,000 in MRR. There were very positive things that were going on at the company. I think if we probably dialed it forward, we all were pretty surprised about what the result was, and the final act that kind of sealed its fate was a very long acquisition process. In a strapped company, or a company that became strapped, and probably doubled down a little bit too hard on this deal, the merits in the deal, and what it could become, and that ultimately that transaction failed. That transaction failed not due to anything on our end, but because of the acquirer and what happened on the acquirer side. So now in reflection, the mistakes. I mean, we could start at day one where the mistakes started happening. We fixed a lot of them. We made new ones, and it was really, it's hard to pick one thing. There were a series of things that could have been done better. The silver lining, perhaps more for me and some other people in the company than our investors and my own capital, my partner's capital, and we all were at a stage then when we could invest alongside, and it wasn't just other people's money. The reality is it made me a way better investor, and it made me considerably more valuable than just my successes as a venture investor, as an early stage mentor. Value to other entrepreneurs. The successes were way more fun, and the failure was way more educational. I prefer to get educated other ways, but or at least that's what I tell myself when I wake up in the morning. So I feel okay.
So that's really interesting. So if I'm understanding correctly, let me just repeat it back to you. I think the biggest roadblock came through an acquisition that kind of fell apart. And so what would you say is the biggest lesson there? Because I actually went through a very similar fate. I don't know if I mentioned this to you before, but with CrowdLinker at the beginning of 2020, I spent 3 months in acquisition talks, doing due diligence and all that with a publicly traded company in Toronto called FaceDrive that, after a lot of back and forth, the deal ended up not going through, and I spent all my attention, all my focus, energy-wise, commitment-wise, to making this deal go through, because I'm like, hey, this is interesting. I'll have a good exit, yada, yada, yada. And then like the pandemic hit, and then everything went sideways. And it nearly bankrupted us, to be honest, at the end of the day. So in reflecting on that, what would you say were the biggest lessons learned that made you a better entrepreneur or investor, having gone through that?
It's a great example you just gave, because we did the exact same thing. Like we devoted ourselves to the deal at a critical time in the company, to selling, and we just clearly didn't do enough of our homework on the acquirer. We didn't understand some of their own structure and dynamics, and we were tight with the CEO. We were in their offices. We were with their board. We were with the chair of their board. Like we thought we were aligned, and we thought we were doing the right thing, but we just didn't dig deep enough, and we didn't understand how their company would restructure due to changes in shareholders and the rights they had, and the path they wanted to take the company versus the path that the chairman and the CEO wanted to take the company. So we got blindsided by that. In hindsight, it's easy to sort of say, hey, we should have saw it. But at the end of the day, we didn't. So there was some level of investigation and understanding that we didn't have, and we committed to it. And that was the other mistake. And frankly, interesting that we found ourselves there. Just thinking about prior experience and knowledge, and we had as far as M&A work as a team. We went through a prior company where, we must have completed 10 deals, including the sale of our own company, successful sale of our own company. So we'd been through this before, and we missed it. And we missed it. But there's also other problems. There were so many things that we could have done differently in hindsight, and that we learned. But the reality is, we didn't have the proper backup if the deal didn't go through, and so we should have always been prepared for that. A deal is never a deal until that thing is signed, sealed, and delivered. It's just not a deal, and that's something I talk to earlier stage entrepreneurs about all the time. Whether it's about a strategic investor that's going to come in, whether it's got to do with their financing round, whether it has to do with what they're banking on in their pipeline. It's amazing what can go wrong in general in business, and in early stage companies, it's mind-boggling what can go wrong.
Yeah, I had a lot of lessons learned there myself, and I realized that the same learning or takeaways, that nothing is set in stone until the ink has dried, and you ideally have the money coming your way, or whatever that transaction looks like. But yeah, I keep telling that to other entrepreneurs, and everybody's just so hyped up about everything. But I'm like, see this through, see what happens, see what other parties are going to start throwing at you, maybe at the last minute, right? There's always these last minute type of things that can totally snowball the whole acquisition.
For sure. For sure. I found there just, somewhat relevant to what I do today, and both investing and thinking about how I kind of work with some other entrepreneurs with respect to matching their capital strategy to their business strategy. I think that the investors and the type of investors and the group of investors on your cap table also need to fit the stage and needs of your business. You never know where you will need more support, and the expectations of the type of investors and the time and stage of your business, and some of the ups and downs and bumps in the road, in addition to where you think you might need capital for in the future, that stuff really needs to line up, and when that's misaligned, you could run into a lot of problems as an early stage company. It's hard to fix that sometimes. It's hard to fix the cap table.
Yeah, exactly. You're kind of stuck to it once it's set. It's set. So tell me, after this business, after this acquisition that fell through, what did you do after? Did you start a new company?
No. That was my aha moment. That perhaps my founder days were over. So this probably went backward for me compared to a lot of other more entrepreneurial stories. I was fortunate to move out to California and late '90s, early 2000s, and join early on a rocket ship of a company out there, and then I moved home to Toronto and was fortunate to build another company here, with friends. We were able to take it public. We were able to sell it to Disney. We were able to scale it. So we had a lot of the success first. We also had some, post that we had some, we had some very successful investments and buyouts of other companies unrelated to that business. So things were good. Maybe we thought we could do anything, it's important. I think about this a lot as an investor. It's important to understand and kind of reflect and be really kind of honest with yourself. Hey, you know what? When was I lucky? When was I smart? When, and I think both is really required for any successful venture or investment. And both will be present, and it's good to be able to isolate the two and make sure you don't just rely on the luck through the next venture because you think you can figure everything out as you go along. So yeah, we were a little backwards. So to answer your question, no, I didn't do another company after. We did all our companies before, and then I realized maybe I was better suited for the investment advisory world.
So I'm curious though, with that, with one of those businesses that you were talking about that I think you sold to Disney, you said it scaled really well. Can you tell us what was that business and why do you think it was able to scale so well? Because I think at the end of the day, it does come, a bit of luck, but then I think you do this enough times, you see the secret sauce or you see the formula for creating a successful, scalable business.
Within the context of formula, so the company I was talking about, the one in Toronto was a company called Caboose. So Caboose was Caboose started out kind of digital media technology focused on kids and family and kind of slightly pivoted itself into a network of digital media properties and commerce platforms for the new and expectant mom market, and we gained a lot of strength there. So we had assets. There were some trends that were really positive. In the early to mid 2000s, that we were riding that really benefited us, from the growth of Google and just new and at the time very cost effective traffic and eyeballs, so we benefited from that. We were able to build a strong team around us with considerably more experience than us, the founders in various areas of the business, or the leadership, the early leadership team, if you will, in various areas of the business. So that really helped us. And I think we had a narrative, and this becomes really important for a lot of the companies I talk to. We had a narrative and a capital advantage. People talk about it in terms of Amazon today, right? I mean, Amazon, I'm not comparing us to Amazon, certainly not, but it just, Amazon's got the ability to raise capital and spend on things due to a low cost of capital that other companies can't. In our small way back then, we had that ability. We could raise capital, and we actually took the company public at a pretty early stage through an RTO on the venture exchange, and made a pretty quick leap to the TSX, to the main board, and that really helped us. So we were able to organically grow our business, but based on our narrative and vision for the future, I think we were able to leverage that and leverage our capital strategy to find great acquisitions that fit really well into our narrative and vision for the future, and we kind of kept building on that, and we also weren't afraid to pivot quickly and kind of refocus the business based on what we were learning in the market. So we learned quickly. I don't think we were necessarily doing great products sprints back then, trying to figure out product market fit with new ideas, but we learned quickly based on what we saw. Early on, we were pretty data focused in terms of understanding our business, and we did build a team that was, at the time, early on, too big for where the business was, and that benefited us. So I'm just picking a few things that I think are still relevant to today.
Yeah.
In a much more competitive marketplace in almost every category.
For sure. And I want to ask you some follow-up questions to that. There's a few, but I want to start off on the hiring of that team, that leadership team. Nowadays, I think even back then, more than ever, it's so important to have a great team or a great management leadership team in place. So how did you make your first hire on that leadership team, and was it a successful one?
We're going back a few years. I'm not sure about the first, but at the time, early on, I remember the most important. Okay. We were able to bring in a sales leader. We were based in Toronto, headquartered in Toronto. All of our business was coming from the United States. So, we set up offices in New York, and we were able to hire a sales leader for the company that came out of traditional media, but at the time, had not just relationships with I'm going to say agencies and large advertisers in the U.S., because early on we were solely dependent upon ad dollars and some development work. We would do creative things for our customers, but in order to compete against Disney and Viacom and other companies in our space, but really the process and the ability to teach other people in the organization something that we couldn't was an incredibly important hire for us. And that changed the trajectory of our organic growth. to the point where, we could leverage it and we could think about monetizing other properties and other acquisitions, so that hire brought expertise and a discipline to the table that we just didn't have. And that began to hold true for other hires in the business. And granted, we made a lot of mistakes with trying to hire a senior leadership team early on in a company. And I can't say I don't know what our track record was of getting it right. But we worked hard at getting it right.
So I think as you said, the most important hire that you had was a sales leader, and I think it's still relevant today. Like I struggle a lot finding great sales leaders in the market to this day. I've hired a few, it didn't work out, and wanted to get your thoughts on like where or what you should look for in that sales leader. Maybe to provide relevancy to the audience who's going to be listening. They're founders, probably doing the sales themselves right now, or hopefully they are. But they need to, in order for them to grow, they need to bring on a great sales leader. And so like, what should they be looking for in that person?
Good question. I haven't actually thought about that a lot in a long time. So, but part of it is goes without saying, fit and culture with the team. Specifically with respect to sales, it's hard to answer that too broadly. Like what stage of company are we talking about, right? Because if you're bringing in if you're pretty early stage, that sales leader's got to sell. So the sales leader and the sales manager and the person who are going to build up, certain operational muscle in your company. A great sales lead early on might be just someone who's incredibly good at selling and can demonstrate how to sell your product, right? I care less about, if it's very vertical specific. If it's very vertical specific, someone's probably got, I'd probably look for someone who's got an understanding of your market. But I also prefer skills and leadership over Rolodex. We target, from a Celtic House perspective in the companies I'm investing in, and just completed my fourth deal with them. A lot of the targets are SMBs, so that is so different. In terms of the company process and the sales system than somebody going after even mid-market or obviously enterprise goes without saying. So like you might not hire. You're not going to hire the same type of sales leader into a company doing SMB SaaS versus a company that wants to go after enterprise sales. Like those are very, they're very different processes. So, I think someone who's, been a rock star selling enterprise SaaS somewhere, bring them down market into the SMB SaaS world. I'd say the person is not going to be a great fit. So, right. What and how do they sell? And then, if you're larger, more advanced, and you're in the growth stage, then you're caring more about the person's leadership abilities and operational muscle and management muscle than you are their pure sales skills. But most of all, my companies, anybody in leadership, rolling up the sleeves and selling. So if you can't sell and lead by example, in my company, my area of focus, that'll be a deal breaker.
Interesting. No, I wholeheartedly agree with that I think the founding team should be able to sell and do so well to get to a certain point. And then
Yeah.
Once you're at that certain point, then, having a better process or like some, methodology in mind that somebody can come in and take it over, I think is the right play. But it's just like, for me specifically, just on this topic, like, I do all the sales myself still to date. I don't have anybody else on the sales team. And the challenge I have is that finding people who understand how to sell in this market is actually quite challenging, because like I would need to go and find somebody who comes from an agency background or can understand, technical consulting, and can be empathetic and, obviously do a good job of trying to sell a story. And I've had some job openings open for like already a few weeks, a month now, if not longer, and like not seeing a lot of great candidates come through, and it's a bit frustrating because I feel like I'll be doing sales forever myself.
Well, I hope not. Maybe you enjoy it and you're really good at it. You have a bit of a sigh there, so it's probably not ideal in your painted picture of the future. Yeah, but we see this all the time, right? Founder-led businesses or founder sales-led businesses have a tremendously hard time handing that over to somebody. And why is it that we see that so often? Why can a CEO sometimes only sell a certain company's services, right? Why do customers only want to hear from the CEO in your business? I'm not saying that's the case, but but I have worked with some companies, mid-market, more complex sales, or mid to high market. I tend to stay out of the enterprise world, but I see the same thing. They bring in people and they try people who look like they've just got great resumes, but for some reason the only person that has incredible success selling is the CEO. And why? I don't know the why is the same for each company, but it is it is something to examine. It is something to question, because I think it's not just, we're having trouble finding the right person or somebody else keeps coming in and failing. The first part of it is is it that the CEO can only sell?
All right.
And then why is it? I'm not saying you need to, I'm not giving you advice. Yeah. You got to go figure that out after this call. But I have seen that with some companies that I mentor, and they have a track record, they have client lists, and just still the only real great sales leads in the companies have been the CEO.
Yeah. No, it's interesting. To be figured out, I guess.
Or keep selling and hire everybody else to do everything else.
Yeah, maybe. That's what I'm realizing.
Yeah,
that's true.
It's scalability though, right? So
Exactly.
Yeah, the scalability challenge.
Jonathan, wanted to ask you about that experience you went through doing that reverse takeover for that company you mentioned.
Sure.
Can you tell us why you did it? What was the plan there?
Yeah, for sure. Yeah, so I've now been on both sides of the RTO process, and we've taken our company public through a capital pool company on the venture exchange, and I'm now the CEO of a capital pool company on the venture exchange that we are rolling another company into that's doing a reverse takeover of us. So, and I've seen this from both sides, and I quite like it for certain companies, and it worked really well for us at the time. So, number one, the market conditions were really positive, and not that I think we did the RTO in 2005, and I won't say we traded amongst a lot of peers in technology companies, like small cap technology companies in the Canadian markets at the time. There's way more now, but we were an attractive alternative to resources and other type Canadian speculative investments at the time. So I think I think timing good. We benefited from that. We did the process because the main founder of the company and his family had a fair amount of public company experience. We knew what we were getting ourselves into. We knew how to manage it. Another important hire, we had brought on a CFO who had, capital markets, a fair amount of capital markets experience and knowledge. So we had the people around the table who could manage it, and we knew what we were getting into. We were top heavy, like I mentioned before, which was, I'm saying that from a positive perspective, that, we could manage a public market strategy and still manage the business. We didn't get too distracted by it. And then at the time, the investment environment from the venture community back then was not as pleasant as it was today. And granted, you'll still get, you'll still see sort of, even a kind of plain vanilla VC investment looks like, some type of pref. But they are certainly less onerous today because it's a much more competitive environment today. Back then, the term sheets from VCs and other investors didn't look great. And, when you've got a lot of your own capital in the business, so you've put sweat in, but you've also written checks in. Sometimes you don't like what those term sheets look like. Right, and those terms look like, and some of the control and decisions that you give up, certainly at the time. Again, I think the environment is a little bit different today, but those were all our drivers back then, and we thought we could manage it well. It fit our strategy and it fit the people in the company. I think today. Even though there's so much, VC and private equity dollars out there, we're seeing companies use just such an incredibly wide variety of financing tools. Like there's been tons of capital pool company reverse takeovers into other shells, and then in the Canadian exchanges, foreign companies are using them more, foreign issuers more than they ever have. You've got, we talked about the crowdfunding earlier, massive growth in, in the ability for companies to, raise directly from retail investors and not just accredited investors. And there's platforms that facilitate that. There's the SPAC market. Might have lost a little bit of its luster of late, but and then there's crypto. There's a whole new generation and type of companies that are raising solely through token launches and offerings, and they're all working on some level.
It depends, right? Some work, some don't.
Returns. Not saying the returns are all going to be there for all of them, but if the measure is getting capital in the door, there's a lot of capital coming in the door through a lot of these methods. It's pretty amazing.
Yeah, no,
anyway,
for sure.
I digress a bit probably from this. Why do we do an RTO? But
no, that's great. Yeah. When you really started focusing more towards the VC side. I wanted to ask you a question that I like asking all the investors that I get to speak with is, when you look at a founder, what are like those characteristics you really look for before you make an investment decision? And like specifically, how do you spot that balance between confidence and arrogance in a way when considering investment into them?
Yeah, so I'll touch on that. I'll touch on that second one for sure. What we're looking for, I think somehow, I do believe that the number one, there's got to be integrity, trust. All those some of those table stakes need to be there, right? Do I want to work with the person? I don't necessarily have to, want to go for beers or like the person too much. We don't need to be best friends, but there's got to be respect, and I got to see just some of those basic trust elements that I believe to be there. And I think you get a feel for talking to people, and some of that stuff has to come through, referrals and talking to other people, and kind of figuring out as much about them as you possibly can. The number one trait of successful entrepreneurs, that seems to be out there is grit and perseverance. We need to have that as investors, in our commitments to the companies, but we've got to see it through. We've got to see that somehow. They have to demonstrate that somehow, as leaders. So what have they gone through? How have they pivoted? How scrappy have they been? How committed are they? We have to see some of those things. So when we see people who have, not that it's always got to be the case. You're not punished for being able to raise money early, but just sometimes people's performance and what they've been able to achieve with by bootstrapping or minimal capital can be really impressive. And so so there's some signs of that. Sometimes we get to see a company early and track them over time, and it's it was a no, not now at the beginning, and then wow, look at you guys have actually done what you said you were going to do, right? Like you got over some pretty big obstacles. The confident versus arrogant one is really hard, and I do not want to invest in a founder or CEO who doesn't bring a fair amount of confidence to the table. I mean, you need it. Like you're not going to have grit and perseverance without confidence. You're not going to be able to get through there. You're not going to be able to lead other people. You're not going to be able to tell your narrative and your story and convince people in the market. So it's important. Arrogance is just. I'm not sure if it's a fine line or not. If that's the way to look at it, does confidence become arrogance if we're not too careful, or do you just start out as arrogant, or do you present arrogance knowingly or unknowingly? I don't know. It's something you certainly sense. There's no doubt, just talking to, you're comparing people, right? Maybe we can talk about pattern matching too, but in business models and investment theses, but you're pattern matching people in this business, and you're seeing a lot of them. And when, there's a lot of really successful, arrogant people, entrepreneurs, and they might just have incredible drive. Is that who I want to work with? I don't know that that's who I want to work with. And I think ultimately that catches up with you at some point. There's lots of difficult situations between an investor and a founder that are not rooted in one party being arrogant or naturally difficult. There's lots of challenging stuff. So, if I sense the arrogance, I'm out, because I just, and I think part of the test on that is desire to learn, open-minded, and how you present yourself.
Yeah. No, arrogance definitely is not a pleasant trait. To that question to my question I want to ask next, around pattern matching. So you've now seen a lot in terms of your, or in terms of the founders you've come across, your investment thesis. What are some of the patterns you've noticed along the way that quite surprised you, that you maybe didn't think about before, earlier on?
I don't know if I've got a good answer for you in terms of where I've been surprised by a particular pattern. I think I'm surprised by how much I myself, upon reflection, have fallen into the pattern matching process, right? Like, because when I'm on the other side of the table for years and I'm raising money and someone's sitting there and I don't fit into their box, I'm like, well, what's the matter with you? Why is your box so important? You don't understand anything. That's my arrogant self. And then, as you come over to the other side of the table, the breadth of deals. Again, I'm a venture partner with Celtic House. I'm not a partner in their fourth fund, and I can have a relatively open mandate. I've done my 4 deals with them, all in special purpose vehicle structure, which has been great, actually, and I plan to keep doing that. But I have a lot of freedom, and I have freedom in mandate. Granted, I know my LPs and I know what my LPs like and what they expect from me and our team or our deals, but I have a lot of freedom. So the problem quickly becomes the amount of deal flow and finding ways to make this process efficient becomes really hard really quick. And so if you're trying to figure out everything and you're trying to figure out all the new models and you're trying to look at too much, you become an expert on nothing. And so not that I want to call myself necessarily an expert on anything I pattern match, but I do it. And so I look for as a starting point, I look for the patterns. Oh, well, that worked well in my last deal, so I'm going to look for it. I'm going to look for it in the next one. And so there's some discipline in there to be open-minded, and not if you're totally locked into your patterns and to just following what made the last deal successful, eventually you're going to miss changes in the marketplace. And I think that's happened to lots of investment funds historically, and you can't afford that. You have to balance learning something new and thinking about new ways of looking at companies and investments, and also try to make your job of investing a little bit easier, a little bit more manageable.
No, that's great. Last question, Jonathan. I know we're approaching our time. I wanted to ask you, what have you become better at saying no to over these years?
My kids? Does that count?
Sure.
Well, maybe because of pattern matching, just relating it to that question. I'm faster to say, and this happened in the last couple of years. I'm faster to say no to an entrepreneur if it's totally not a fit, and even if it's just not ready to be a fit, I'm faster at doing that. I think it benefits everybody. In early stage, if and I see this through mentorship, it's easy for an entrepreneur to get excited about discussions that they're having, and most of them aren't going to be good discussions, just based on a numbers game. That's very detrimental on a number of levels. So I try to do it for them, and then I do it out of necessity for myself and my time. But I do stress, the ones where it is the ones where it's like, no, completely not a fit and never be a fit, clear with that. But then, quite often it's, no is not now. And, keep in touch with me. Let's track your company. Let's build a relationship. The majority of investments seem to happen that way.
Got it. Okay, cool. Jonathan, thank you so much for your time today. I really appreciate it. And thank you to all of our listeners for subscribing to our podcast. Stay tuned for another Off the Record episode. Jonathan, thanks again.
Thanks, Aram.